When we are talking about transaction cycle and auditing, we are talking about looking at the event that started a transaction to the end of the transaction thereof. Basically, just take for example, when we are talking about a sales transaction, we will be talking about the order, because if a transaction is not ordered by a client or customer, we cannot sell to him or her or to the institution. So we'll be talking about the order, the packaging, looking at the credits policies, looking at delivery until the final consumer receives our services. So basically, that is sales transaction cycle. And in this video, basically what we are going to be doing is to talk about assertions, what are assertions we need to know, and how those ones need to help us in achieving our auditing of income statement. Basically, we are picking a line item or two major line items in statement of comprehensive income, and we are going to do justice to it. And you know what, after that we can apply this knowledge to every other aspect of transaction cycle auditing, basically. So that is what we are going to do. So what are assertions? Assertions basically are the words from the management to the auditors assuring us of some aspects, basic information, and their knowledge of what had transpired during the year under review. And the letter from the management to us about assertion must contain, among many other things, accuracy. So they must assert as to accuracy. Assertion simply means equally affirmation or affirmations from the management to the auditor. So they must affirm as to the accuracy of transactions in the management account being presented to the auditor to audit. They must talk about the cutoff period. They must talk about the classification. It's another assertion. They must talk about presentation. They must talk about completeness of the transactions to the best of their knowledge. We are actually going to pick all these assertions one after the other and use them in auditing the aspect of income statements, which definitely must deal with the credit sales. In an income statement or in sales, where we have cash sales just as we have credit sales, and in an income statement definitely we must have expense line items, right? Okay, so let's take now the assertion about accuracy. Accuracy. The management told us that to the best of their ability, the financial statement is accurate. Now we want to confirm that the sales aspect is accurately presented to us. We need to understand some key documents, transactions, tracing that must take place. For sales to be accurately recorded, we need to check the price list. What is the price list? At a particular time the item is being sold. So is the amount that we have on, let's say, the invoice now correlates with the price list? Of course, the quantity may differ, especially if we are on the maybe manufacturing side or goods side, not on the service side. And even on the service side, there are standard fees that are charged for services rendered. So we need to check our service price list too, our client's price list, service price list, and confirm and trace it to the invoice to confirm that what we told the customer or the client, that this is the amount we will be selling to them is what we eventually sold to them. And you know what? Between the selling to them and sold to them, we need to confirm and trace from invoice to receipt. Basically, the difference between invoice and receipt is invoice is at the point of acknowledging and ordering, that showing intention to buy from us, and receipt is at the end of we had received money for the value we've added to the customer or to the client. So that is how to trace the accuracy or accurate recording of a transaction. Let's say, for example, the sales transaction. Now, equally, the cutoff period, which simply tells us that the year under review, transactions under the year are only presented in the books of accounts. It is possible for so many reasons, maybe due to error or for any other intention, client could include some other invoices or sales that are not within the period. So we need to check especially those transactions, sales transactions that started the year, and those transactions, sales transactions that our client and customers actually ended the year with. They are very important to the transaction tracing and transaction cycle auditing of our clients. Once we are able to do that, we will ensure that the items we have or the total sales we have on the income statement actually are representative of what transpired during the year. We've spoken about accuracy, assertion, we've spoken about cutoff period. What of completeness? That the items are actually completely recorded. We need to check that the completeness are intact. Therefore, we need to look at the sales invoice, the shipping document, let's say for example, in which we will receive the items. We need to look at the sales journal. We need to trace items to sales ledger and some other key documents that the organization will have. What we need to trace it to will depend on our knowledge of our customer. And that is why in auditing we say know your customer. We need to know our customer. So we need to trace for completeness of recording. Ensure that the shipping document correlates with our journal entries that our client has made, and those journals are authorized by necessary level of approval, and all those journals are legialized, and those ledgers form part of the trial balance. That is tracing of transaction for completeness. Also, we may need to isolate some transactions that took place during the year and establish them as per where they're supposed to appear in the documentation, culminating into the trial balance, culminating into the statement of comprehensive income, and at the end of the day show up as part of the retained earnings and what have you. Another assertion that we need to equally talk about is the assertion about proper classification. Proper classification. Ensuring that items, let's say for example, now that we are auditing income, credit or creditors information are not put as sales. It's possible that a credit account is being displayed as income. That is a wrong posting, but it could happen. So now is the work of the auditor to ensure that proper classifications were made in the book of recording. And we need to ensure to know the nature of transaction. Let's say, for example, a person had interest in an organization for financing and funding us, and rather than for any reason the account personnel to have posted into the personal account or into the share premium account, into share capital account, was wrongly posted into, let's say, credit sales, because they were actually both credit line items. There are accounts that will receive credit on the credit side, but it does not say that the personal accounts now become the sales transaction account. So we need to dig deep into the nature of the posting, then we reclassify if need be. So when we put, let's say, for example, we find credit funding, our client's credit funding in sales ledger accounts. Now we need to actually debit that account, the sales account, and go and credit the finance, that is credit funding or share premium account, for proper classification of that transaction. We are already going into how to correct errors observed during the audit, but it's part of the knowledge that we need to get, because it can come out. It's something like that actually came out during my set long time ago, and as at that time I was an auditor, so it was even easy to pass the diet. So maybe it could happen to you. So we've spoken about completeness, accuracy assertion, cutoff period assertion, classification assertion. We need, as auditor, to ensure that everything is properly presented. Presentation of our clients' accounts. We are talking about IAS1, if I'm correct, that deals with proper classification, a proper presentation of accounts, that every account, like for example, should have comparative figure, that is figures that we can compare this year's transactions with. So unless it's a first year audit, we must ensure that we have part of our presentation checklist must to ensure that every figure that we are putting in the accounts as audited accounts has a corresponding related figure last year. And if for any reason we need to reclassify, it must be reclassified to ensure that those items in last year are representation of what we have this year. Should I come slowly there, because that seems a bit technical, what I just said. For example, let's say in a summary figure of, let's say, cash sales this year, we have some transactions or some clients that normally feature as cash clients. But for any reason this year now, they feature as credit sales customer. And if care is not taken, because they were usually on the cash sales transaction, if care is not taken, by the time we are comparing them, our client could have put them as cash sales. Meanwhile, they are not cash sales. So we need to ensure that the well presentation, balanced presentation of account. Now we've actually dug deep into the presentation. Ordinarily, at the face value, we must ensure that every account has corresponding comparative figure, basically. So for transaction cycle to take place, we must ensure to trace from the beginning, to understand the beginning of that transaction. What are the things that must be involved during the process, and at the end, in which accounts should they actually be registered or featured. Basically, that is the transaction cycle. First of all, tracing from the beginning to the end. And in the middle, there are a lot that goes into it too, which we need to understand. Then we tie everything down together. We tie everything together, and we said that transaction cycle had actually been audited. We had looked at basically the income statements, and basically I dwell on the income side. We could have moved forward for expense too. Let me just do one or two expense auditing so that at least we can have a bit of holistic view of income statements. Then we can apply the same knowledge to the statement of financial position auditing and the like. Of course, when we are talking about the expense, and before I actually move on to do that, this is GJAMES Associates channel, and my name is Gbenga Olatunji FCA. For those of us that are just joining us for the first time, subscribe and click all as notifications so that anytime we upload, you will be the first to be notified. It's important that you click like so that the algorithm of YouTube can pick it up and redistribute it to other people that need to actually have this video for their career journey. Okay, and any comments, please put it in the chat box. You can be sure we are going to respond. Okay, having said that, when we want to audit expense, basically the same assertion we go for it. We need to ensure the accuracy. We need to ensure proper classification. It was well presented. The cutoff period is taken care of, and completeness of the whole expense transactions. Having said that, another thing came to mind which is very important. There is difference between expense and expenditure. Expense are actually those transactions that end inside the statement of income statement, pardon me. But expenditure are actually capitalized. Try come slowly. When we expend, they are written off into income statement. But when we have expenditure, they are items, transactions of capital nature, which our organization policy must have supported. We call it CAPEX. Those items, even though they are debit items too, must not be found in our statement of comprehensive income. And that is part of what auditor needs to look at. Now, if we find that some transactions are actually capital in nature as per the policy of our client, we need to reclassify them and move them to the statement of financial position. I hope we understand. So that is part of what we need to do. Two, we need to ensure accuracy. That is, they are accurately recorded. Take, for example, an expense. We need to take approval and ensure we have evidence for its approval. We need to be sure that is reasonable, is genuine expense. We need to ensure that somebody actually got paid for it, and we have evidence as to the value we've received, or our clients now are received for spending such monies. So between the time that there was a requisition from our client's office that we need to make such payment because we need to buy something like this. So requisition must be made formally and must be approved by an authorized personnel. Let's say, for example, the HOD of that department, that we actually need this thing, and must go into the people, must go to people that actually we need to disburse the money. Let's say, for example, treasury. If the organization is large, they are going to have treasury departments separately. So the treasury need to disburse the money, and by the time they disburse the money goes out to the people that to our supplier. Then by the time the supplier supplies, we need to have evidence that those items we paid for, I'm talking about our client now, right? They have documentation that those items are okay. They are what we actually requested for, the quantity our client requested for, and the money was well spent. We need to look at the presentation too. It's properly classified. I've talked about that. We need to ensure that they actually occur. Every line item expense in the book are actually they actually occur. It is possible for our client to include fictitious recording, that is expenses that does not exist for any reason, maybe to lower down the profitability, or for any reason, and that is why auditors are there to actually do the job. So we need to ensure that items, expense items, are actually genuine. They actually happened, and the client we are auditing receives value for those payments. And if those payments cannot be written off within a year, we ensure that they are properly classified based on their capital expenditure policy. From GJAMES Associate Channel, Gbenga Olatunji, FCA has been speaking. We are value to life. We are value to your businesses.